Hello and welcome to What Goes Up, a weekly markets podcast. My name is Mike Regan. I'm a senior editor at Bloomberg.
And I'm Vildana, Hajric, a cross-asset reporter with Bloomberg.
And this week on the show, well, in case you missed it, there's a little bit of tension brewing on Wall Street. Many economists and macro-oriented investors are bracing for a recession in 2023. And with that would likely come a nasty drop in corporate profits. But analysts who study individual companies haven't reduced their profit estimates enough yet to signal an earnings recession is on the way. So what exactly is up with this disconnect between the top-down and the bottom-up views of the market? And what does it mean for your investments in 2023? We'll get into it with one of Wall Street's best-known strategists. But first, Vildana, I got to tell you, I'm freaking out about something.
About what? You're freaking out about a lot of stuff.
I'm freaking out about something, yeah.
What is it?
What do you cook your cauliflower with? What type of stove do you have?
Oh my God, this is a sore subject for me. Our gas is out in our building, so I'm not cooking anything right now.
That's good. That's good.
Why?
These gas stoves are killing us all. Do you realize this? There's this big,
they're banning them, right?
They're going to ban them all. I'm very alarmed by
that
this.
news came out the same day that they turned my gas off. Well, in my entire building.
So you're just
I'm just not going to eat. I'm just not going to eat for the next 3 months probably.
I think this is a scheme by DoorDash. I think they want you to go long DoorDash. What do you think?
We should check how much they're paying lobbyists to kill gas ovens.
All right. Well, maybe our guest has some thoughts on DoorDash.
She might not.
Probably not. I'll spoil it. Probably not.
But who doesn't like delivery? Everybody likes delivery, including our guest probably. I want to bring in Savita Subramanian. She's the head of U.S. equity strategy at Bank of America. Savita, welcome to the show.
Thanks for having me, Vildana. And I do love delivery.
Who doesn't?
I wish my gas stove was out so that I had a good excuse not to cook.
It is a very good excuse to get takeout.
I always thought my gas stove was going to kill me because the kids always leave the pizza box on top of it, and I'm afraid the dog's going to sniff the pizza and go.
Yeah, and turn your oven on.
Yeah,
these are some crazy thoughts.
Little did I know this.
It won't happen. Yeah. It won't happen.
All right.
But Savita, so Mike mentioned in the introduction, you're one of our best known strategies on Wall Street, and so I wanted maybe to just start out having you tell us about your year-end price target for the S&P 500, and I believe that you guys also have different variables and scenes playing out for the year. Maybe you can talk about those as well.
Yeah, absolutely. It's so our official year-end target, it's kind of a point in time forecast where we think the market will close around 4,000, the S&P 500, which is really limited upside from here. But we think there's a lot of moves within the year. So let's talk about a range. I think our bull case, if everything goes right, we think the market could go as high as 4,600, which would be a pretty great year. And then our bear case, and what we think is a reasonable floor for the market, is 3,000, which would be quite a big drop from here. So, I think our views are in 2023, it might be a less than stellar year for the index, for the market index. But we think there are going to be a lot of great opportunities within the S&P 500. And, I think that's where we're really focused with our views is what sectors, what themes, what areas within the S&P 500 can actually do pretty well this year, amidst a backdrop of relatively muted returns for the overall market.
I want to get into those themes and sectors, Savita, but like I said in the introduction, I'm fascinated by this notion that pretty much everyone assumes all these earnings estimates from the analysts right now are wrong. All the top-down view of the market is that, what are they thinking? These estimates have to be cut. What do you think explains that? I mean, are analysts just sort of waiting for the companies themselves to lower guidance? Is this fourth quarter reporting season really going to pull that out from all the conference calls? How do you see this unfolding? I
think you're right. I think that analysts are in sort of wait and see mode, and maybe even companies are in wait and see mode because, the real positive surprise over the last few years is that despite rampant inflation, cost pressure, wage pressure, everything going up to, pretty high levels in terms of, kind of margin pressure, companies have managed to navigate this by either, pricing products more aggressively or by, cutting costs. And I think on top of that, we're seeing corporates very nimble in terms of cutting costs. A lot of the headlines recently have been around mega cap tech companies, kind of reducing their compensation cost structure by layoffs, not necessarily great for the economy, but good for their bottom line. So I think that analysts and, and corporates are probably a little less convicted in terms of margins and cost pressure and pricing power going forward. Our view is that we are likely to see some downward revisions. And, our forecast for profits growth for 2023 is, $200 for the S&P 500. And that would mean about a 10% decline in earnings, peak to trough. Now, I think that makes sense to us amidst forecasts for a recession. This is, one of the most widely telegraphed recessions of all time. I think we're all just sitting here bracing ourselves for it. A 10% drop in earnings would actually be half of the typical recessionary corporate earnings drop. So we think that we are going to see those estimates come down, and it's likely to happen after companies guide more aggressively lower around 2023 earnings. But, I think where we're going to see pressures are in companies with more labor intensity, like services companies, companies where you're really seeing cost pressure remain high. Those are the areas where we think that we're going to see some downward guides on margins.
And Savita, I want to ask you about what specifically you'll be looking for this earnings season. And I think you guys have really great daily and weekly research. I remember from past earnings seasons that you have, maybe it's sort of like an AI-driven model or something along those lines, where you sift through all the earnings reports and you look for keywords and some of the things that are mentioned the most number of times. So if we have peak inflation behind us, what will you be looking for? What keywords, what trends and will you be sort of cluing into as these earnings reports roll out?
Yeah, thanks for that question, and thanks for reading our research.
I always read it.
We do a lot of kind of text analysis, and some of the things that we've been able to unearth during different periods are, kind of inventory pressures, demand destruction, inability to price. So this quarter, what we are laser focused on are a couple of things. As I mentioned, we want to hear more from companies around whether the tightness in the labor market is alleviating, because that has been the theme for the last, almost 8 quarters now, is just the inability of companies to source labor unless they dramatically increase prices, especially at the lower income end. We're also listening for more news around layoffs in services sectors. So, so far we've really heard it only from, mega cap tech companies. We're waiting to see whether that spreads to a broader array of companies. We're also listening for thoughts around, kind of this inventory mismatch. So we've seen some of the supply chain frictions alleviate, and now we're wondering how much inventory companies have to work off, and that could be another drag on pricing power, demand, earnings pressure, et cetera. We're all, I think some of the other factors that we're paying attention to from an earnings per share perspective are buybacks. So, the last 5 years we've seen buybacks contribute about 10 percentage points of S&P profits growth. That's a huge amount, and it's really unusual versus prior cycles. So if that buyback trend also decelerates, and there are good reasons to believe it does. I mean, the government is now taxing corporate buybacks. Companies might be more likely to hold cash rather than spend it on buybacks if we are worried about a downturn. So that's another trend we're listening for. And our view is, again, per share earnings growth has been really juiced up over the last 5+ years by just, rampant buyback activity. And if that cools, that will be another source of potential risk to earnings going forward.
Savita, you mentioned some of the layoffs among the big tech companies. I think a lot of people are bracing for perhaps a wave of layoffs in the financial sector, which I'm assuming a lot of our listeners are employed in. Are layoffs automatically good news for the share price this year? As just to be blunt and say it out front, if I see a headline, such and such is cutting X percent, is that automatically good news for the stock price, or is there more nuance, do you think?
Well, it's good news in that the company is being nimble in addressing this issue of, bloated compensation costs and maybe, rationalizing capacity. But I do think that the signal it's giving us is that this company is in workout mode. So yes, they're being nimble, they're addressing these issues, but first of all, it means that they, sort of misallocated capital in a better period of time. And second of all, it means that from an economic perspective, especially I think heading into this recession, what could be different this time is that a lot of the layoffs are really happening at the higher income end or the skilled labor end. And what that means is that, typically in a recession, luxury goods are more defensive than lower price point products. But in this recession, maybe luxury isn't as defensive because a lot of the layoffs are really much more acute at that kind of skilled services and tech level. So those are some of the things that we're watching. From a company perspective, for the most part, we've found that investors have lauded the news around layoffs. As a source of alleviation of margin pressure. But I think that, whether or not that's enough to offset the also deteriorating demand is the big question. So top line becomes important. Yes, companies are being very nimble at managing costs, but they're doing this because they're seeing less demand and less ability to, continue operations with their current labor setup. So that bodes ill for, demand in terms of kind of top line growth. When we look at tech companies, one of the things that worries us, and we're underweight information technology as well as communication services. And one of the things that worries us is that, kind of similar to Y2K back in 2000, we've seen this massive pull forward of demand for tech during COVID, work from home, all of the telecommuting that we've done. And so what we're seeing now is potentially a hit to CapEx on software of companies that already sort of, really addressed their software spend over the last couple of years. So I think that's what we're worried about for tech companies is, maybe what they're doing is great in terms of managing costs, but how much of their demand is really cyclical rather than as sticky as what everybody was forecasting, in prior years.
And we mentioned recession a couple of times now and how this is one of the most well-telegraphed recessions ever. But you actually say that this is not your mom and dad's recession. So I'm wondering what you are expecting and how you might characterize it.
I will say, Vildana, that was good news when I read that because my dad was born right at the beginning of the Great Depression.
Oh,
so it's for me, this is good. This is especially good news. That's why you could, throughout his life, you could put like 10 pounds of spaghetti on his plate. He'd eat every piece of spaghetti because
I would too, though.
Yeah.
Right.
Spaghetti's good.
Exactly right. I mean, I think that when we think about our parents and, prior generations, recessions looked really different. And I think, obviously the Depression was one of the most acute recessions we've ever seen. I think even 2008, when you think about kind of the drama that took place within corporate America, within consumers, homeowners, it was really broad spread. It was driven by this, massive credit cycle. And I think the good news is that today, corporates and consumers actually look pretty well capitalized, at least for the time being. And maybe that's just a function of really low interest rates. But I think what corporates learned in 2008 was that leverage is evil. And they have now locked in relatively long dated fixed rate obligations on the debt side. Like, to me, the most encouraging number is if you compare today's average maturity of debt on S&P balance sheets to that in 2008. To date, debt terms out at about, on average, 11 years. Back in '08, it was more like 7 years. So we've seen this longer duration exposure to fixed rate debt, which I think is good news, because that means that higher interest rates won't hurt these companies overnight, and they have time to navigate that process. Consumers similarly they got a big bolus of cash from the government in 2020, 2021. So, balance sheets of consumers and corporates look pretty great. The government is holding the bag when it comes to debt. So if you look at deficit, if you look at Fed balance sheets, I think what's different today is that the Fed has never had this type of an asset base. We've seen trillions of dollars of, kind of bond purchases occur over the last 10 plus years, which have been great for risk assets, but not, how does the Fed navigate unwinding all of that debt? I think that's the $1 trillion question, because we've never seen this movie before. And that's what we're a little more worried about, the public sector than the private sector in this recession.
I think what blows my mind the most is, we are all expecting this recession, and then yet you write in your quant models, the most attractive sector is financials, which, would not be what you would expect.
Yes.
Ahead of, at least these big recessions that, 2008, 1929, that sort of thing. So, yeah, I guess to some degree, that's just a testament to the effectiveness of the reforms of 2008 and what a different economic environment it is with a high inflation and everything. But walk us through what makes financials stick out in your quant models to be so attractive.
Yeah, I mean, it's a great question, because I think when you think about what to own in a recession, financials would probably be the last sector you'd want to own. And it's because we all think about 2008, where that was the point of maximum pain. Today, I think the good news is that financials companies are not necessarily holding the credit risk. They haven't really been allowed to lend to low quality consumers. They've been, kind of regulated by the government, forced to arguably overcapitalize balance sheets. Or, today, if you look at a chart of leverage for financials, we're at, a sixth of where we were in terms of leverage risk relative to 2008. And we've never seen this type of a monstrous drop in leverage going back to, the 1930s. So I think where the lending risk resides is not necessarily in US large cap banks or financial companies. It's really outside of the financial sector. You've seen a lot of lending through private equity, venture capital, companies that have burgeoned in an environment of zero interest rates, zero hurdle rates, kind of free capital. And I think that's where we are more worried about this unwind of public sector debt. So like I said, it's not your mom and dad's recession, in that the credit cycle, we are seeing credit conditions tighten, but it's not necessarily as threatening to banks, given that they've been regulated to deal with these types of credit cycles from lessons that we learned in '08. I think financials is also this sort of closet high quality sector. And it feels weird for me to say this, having lived through the financial crisis. But when you look at the earnings variability of financial companies relative to the market, tech is a far more cyclical sector today than financials is. Financial companies actually have lower earnings volatility than the S&P 500, which is kind of shocking, right? I mean, it's almost like financials has morphed into the regulated utilities sector because of, the fact that these companies have been so scrutinized and have been so disciplined about capital cushions.
Savita, I also want to ask you about this point that you make about how bonds over stocks is now the consensus for at least the first half. But then you also add, given drops in equity sentiment and positioning, one of the biggest risks today might be that of being underinvested in stocks. So how are you thinking about this? Because we've also been hearing from people, I think even Gunlock said it earlier this week as part of his quarterly webcast, that people should be positioning 60% in bonds and 40% in stocks. And I'm wondering what you think about that.
Look, I mean, I think that bonds did horrifically last year. So one could argue that there is some, kind of upside risk to fixed income. From a yield perspective, bonds now offer much more competitive income than the dividend yield on the S&P 500. So a lot of things have changed over the last 12 months. But I think what worries me is that when you think about bonds, the biggest demand for 10-year treasuries over the last few decades has been from the Fed buying bonds through quantitative easing and from China buying US treasuries. And both of those big sources of demand have left the building. So I think that that's something we need to think about is quantitative tightening is happening real time. I mean, it started last year, and basically our rates team thinks that quantitative tightening as projected will basically remove about $1 trillion+ of demand for treasuries over the next 12 months. That's a lot of money. And we don't know who is going to step in and fill that void. So our view is, okay, yeah, bonds are offering a higher yield than they were last year. So from an income perspective, they do look on the margin more attractive than a lower dividend yielding equity. But if rates continue to rise and if that demand for bonds is continuing to wane rather than wax, that's where I worry about the upside risk to interest rates and thus downside risk from a price perspective to bonds. I think also what's shocking to me is that over the last 12 months, all of the equity bulls have become bond bulls. And one of the most consensus themes that we hear is, buy bonds in a recession and then move into equities in the recovery. Our view is this, like I said before, this might be a very different recession where bonds don't necessarily hold up as well. And the reason is that, the twin deficits, the fact that the public sector is holding the leverage. So our view is, okay, sure, dividends are lower, but there are still a bunch of stocks in the S&P 500 that offer competitive yields with bonds and with the fixed income markets. And the good news is that equities can grow their earnings if inflation remains sticky and high. So buy companies that have, reasonable dividend yields and also the ability to navigate an inflationary environment or rising interest rate environment and continue to grow those dividends and remain competitive with fixed income. So I still think that the argument for holding equities in a rising interest rate environment remains intact. Companies have the ability to grow earnings, whereas fixed income is exactly that, fixed income. You can't grow your earnings in an environment of rising interest rates.
And with, equity income sort of being a much bigger potential source of return, I think, than it has been in the last decade or so. To simplify it to sort of the most simplest terms, is it like buy the aristocrats index type of thing, do you think? Or that type of company?
That type of company, exactly. These boring kind of steady Eddie companies. In fact, my favorite screen, and I tell my parents about this, I tell my friends about this, but my favorite quantitative screen is like the easiest thing to do. So you take the Russell 1000 stocks, like the 1,000 largest companies in the US equity market, take the largest 1,000 stocks in the US equity market. You look for the dividend yield. You rank all these companies by dividend yield. And then instead of buying the highest dividend quintile, you buy quintile 2. It's that easy. So just buy quintile 2 of the Russell 1000 by dividend yield. And what that does is it gives you kind of competitive yields with the market. So you're buying companies with higher dividend yields than the overall market. But you're also screening out companies that are becoming very high dividend yielders because their prices are falling and they're about to cut their dividends, because that is anathema. And especially during a recession, that's where a lot of these high dividend yielding companies end up in purgatory for cutting their dividends. And then you also basically clip that coupon and you avoid companies that are growing too expensive when their dividend yield drops, below a certain threshold. So that's where I think the real action is going to be from a total return perspective. And one of the things that we found is that quintile 2 by dividend yield has outperformed every other quintile of the market and has offered a much lower probability of losing money than other areas within that dividend spectrum. So similar to the aristocrats, it's really the idea of don't stretch for yield, but look for safe and growing dividend yield.
I wanted to ask about your process and say I put you on.
Now we know it.
Now we know our favorite screen. That's a good one. In fact,
yeah.
I have a headline in my head already about
That's
that.
right. The secret sauce.
The secret sauce. But I'm curious, since you and your team are so well followed, so respected and influential on Wall Street, I'd love to know just kind of the basics of your process. Say I were to take you and put you on a desert island for a year and then bring you back and put you in front of a computer. What would be the first sort of things you would look at?
Yeah, I mean, I think that, it's always changing. So that's the tricky part. For the last 10 years, one of the things that we've been forced to pay attention to is how much the Fed and stimulus have juiced up the market. So I think having a whole slew of macro charts showing inflation trends, valuation trends, leverage, kind of the big picture story for what's been happening in the world. So if in 12 months we come back and we see that the Fed has successfully unwound all of the quantitative easing that we enjoyed, we'll feel a lot better about the market because we're past that point of the unknown. I think also, what we try to do is look at, when people talk about, what you want to do is buy the cheapest stocks in the market. Well, some of the things we try to do is we test those theories. And in many cases, they hold true. But in many cases, they are patently false. So I think, a lot of our work would be centered around, okay, this seems like it's a thesis that makes sense, but let's test it. Let's see how those stocks that had, the lowest valuations, the highest free cash flow yield, all these different things that investors care about. Let's see how they actually did in the real world. And one of the things that I find fascinating is that human behavior drives a lot of asset class rotation. And this is sort of similar to the bonds versus stocks argument. So, when you start to see if I come back in a year and everybody hates bonds and loves stocks again, that's going to change my tune around, whether you want to be in stocks or bonds. So I think that also paying attention to sentiment, positioning, crowding, themes that are just well vaunted and everybody's expecting something to happen. Those are also really important to pay attention to because, while we learn in finance classes that it's all about earnings growth and terminal rates and, all the numbers, in reality, there's a huge amount of psychology involved in what works in a market cycle. So I think that's also really important to pay attention to. Basically, just as much data as I could get my hands on, I think would be the answer to your desert island question.
And memes, of course. Don't forget the memes.
Yeah, don't forget me. Twitter.
The meme stocks are back in action. Bed Bath & Beyond, did you see that?
That's right. Yeah. I mean, we don't pay as much attention to that because I feel like the alpha there is so short-term, so unpredictable that it's almost easier to fade that and wait for it to be behind you.
There's some good memes about Bed Bath & Beyond going around now. Because apparently they use foam to make their towels look so pristine in the stores. Really? So now there's pictures of it all over Twitter at least, which I need to spend less time on. Yes. Okay, one more very cool point from one of your notes. You said the market is hoping for a Fed pivot, but it really shouldn't. A Fed easing cycle amid tightening credit conditions, i.e. recession, has been the worst backdrop for stocks. And I feel like you're like the first person I've heard say this.
Yeah, I mean, I think what a Fed pivot would suggest is that the Fed is worried. And, I think basically what we found is that when you're in that environment where the Fed has been tightening, credit conditions have been tightening, and the Fed feels as though their tightening has actually worked, it's sort of too late. And the damage is done within markets. And until credit conditions actually ease, you don't want to be involved in equities. So our view is Right now, what's happening is the Fed is tightening and credit conditions are tightening. What would be a better outcome is if credit conditions actually eased in the next 12 months. And we don't think that's going to happen. We think the Fed is going to continue to tighten to try to cool this white hot economy, super high inflation. And they will, like they have in every other cycle, probably go too far, at which point you really don't want to be in equities. You're really in that demand destruction recession mode, which is a period of time where equities generally do the most poorly. So I think that, what we're seeing right now is sort of the Fed is doing what they probably need to do. They're trying to cool inflation. They're trying to unwind a lot of the benefits that we enjoyed over the last 10 years. And them stopping prematurely wouldn't necessarily be a great sign. It would be a sign that, we're really in a demand slowdown, and that would be negative for earnings. That would be negative for cyclicals. That would be negative for the economy, et cetera, et cetera. And that's, precisely when you don't want to own cyclical equities.
Savita Subramanian, it's so great to catch up with you and hear your take on the markets. We can't let you go just yet, though. We have a little tradition here on the podcast. Vildana, what's it called?
Craziest thing. I always get it wrong. Weirdest thing.
How many times have we done this?
I always call it weirdest, right?
It's the craziest thing. We can call it weirdest if you want.
I always get it wrong. I'm sorry. I will literally never learn. I will go first. Mine is actually very good.
All right, let's hear it.
Okay, it's super fun. Okay, I picked it with you in mind.
Oh, boy.
There's an India-based company called Dream 11. It runs a fantasy sports platform. And now their employees have to pay a fine of $1,200 if they contact a colleague while the colleague is on a day off.
Really? I like that. I like that.
Isn't that crazy? I guess this company has a policy where workers have to take at least a week off annually. And so if somebody emails you, they have to pay this huge fine.
Why did you think of me on that?
Because you love to email me when I'm off.
But it's usually about the Buffalo Bills or something. It's not.
Yeah, or about the podcast.
All right, fair enough. How about you, Savita? Have you seen anything crazy recently?
Here's what I think is crazy. Feels like every investor is laser focused on what the Fed is doing with the short end, with Fed funds rates, how much they're tightening on the short end. But the truth is, it doesn't actually matter that much. The long end is much more important, and nobody is talking about quantitative tightening. That, to me, is the craziest thing in the market, is that we are all focused on the exact wrong part of the curve.
That's pretty good. That's pretty good. Well, I mean, is there a potential for them to ease up on quantitative tightening before cutting rates, you think? And how would that be perceived?
Well, I think that that's what everybody is hoping for, but I don't necessarily know if that happens. If they really want to control inflation, they need to tighten on both ends. So, I mean, I just feel like this is the market cycle where, here's the other crazy thing. So if you think about the average portfolio manager, the average age of a portfolio manager in the United States is about 43 years old.
Ah, make me feel old.
No, me too. I am consistently
over the hill,
the oldest person in the room in client meetings. And 43 years old. So think about it. This has been a cohort of individuals who have worked during a period where all you needed to do was buy the stocks that went up. Momentum was the best stock selection factor for the last, couple of decades here. So that's what portfolio managers and professional investors have been sort of trained to do on this, almost in this Pavlovian process. And, valuation hasn't mattered for a very long time, up until the last couple of years. So I think that's another very interesting part of this environment.
Yeah, definitely. On the flip side, though, they also grew up with supercomputers, and, we didn't even know what quant and factor investing was back in the day. So, there maybe there's an edge there too, to the youth and the technocratic nature of it.
That is very true.
The youth, those youthful 43-year-olds.
The youths.
Those young whippersnappers. All right, that's pretty good. All right, Savita, my crazy thing, I had you in mind, and Vildana, because I'm going to pit the two of you against each other in our game show, The Price is Precise.
The Price is Precise. Not The Price is Right, Savita.
Yeah, yes. Completely different.
So different.
Completely different. But Savita, I know you look at a million different points of data. One thing I don't ever hear anyone talking about is actually the share prices of different companies. You never hear any analysis, for good reason. What's it really matter? Or does it? I don't know. So the question is, what's the highest stock price in the S&P? I'm not talking about a valuation. I'm not talking about...
It's Berkshire Hathaway.
It's not Berkshire Hathaway.
What?
They used to, well, remember, they were excluded from the S&P for a long time.
I don't remember.
Before they did the split to...
It's not Berkshire Hathaway?
It is not Berkshire Hathaway.
The highest price stock in the S&P 500?
Just share price, not price to book.
Yeah.
PE.
Right, just share price.
Just watch her, Vildana. Make sure she doesn't pull up her.
Oh, she's going to know.
I'm not looking at anything. I'm looking straight at the camera. I mean, I would have to say it's like one of the mega cap tech companies that haven't split, but I feel like all of them have split.
That's true. Amazon also
remember,
did a split.
It's a crazy thing because you're probably not going to get it. It's a company we never hear much about.
Is it one of those like...
I'll give you... You're right. I don't think it's ever done a split. It did a reverse 1-for-30 split way back in 1993. No splits since then.
I bet it's one of those like research companies. What's the one? They just like have like public profiles and do consulting for different public companies.
Oh, like...
shoot. I'll remember it.
All right. Wild guess just at the price. You don't have to name the company.
$1,800.
$1,800. Savita, what do you think?
3,000.
3,000. Savita's a little bit closer. $4,828 per share, down from a peak, by the way, of $5,959 in December 2021. You'll never in a million years guess the company. NVR Inc., the home builder, trades for almost $5,000 a share.
I don't even know this company.
So you think about that, a round lot of NVR is going to cost you $500,000, basically. Isn't it silly not to split that, Savita? Like,
yes.
Isn't there a liquidity premium that you're missing out on and everything?
I mean, absolutely. That is a wild... How many shares are outstanding? Like,
I don't know. I think it's like a $15 billion-ish market cap. So,
wow.
I don't know.
Interesting.
I never would have guessed it. And that's why I think it's the craziest thing I saw this week.
That is wild. But now I'm so bothered by not being able to remember the other company I was thinking of because I didn't really even guess one. So
NVR.
Wow.
NVR. Okay.
That's wild.
Is the craziest thing I saw this week.
The wildest thing I saw.
But I'm glad you didn't guess it. Actually, I was thinking Savita's going to get this, but I'm glad you didn't.
No. I'm not a stock jock. I'm more of like a macro factor person. So yeah, I was flummoxed by that one. That is a good question.
That's good.
I find it silly that a company would let their stock price trade that high, but
it's really
maybe they're proud of it.
Yeah, exactly. I mean, we're all talking about it, so something right.
Anyway, Savita, so great to catch up with you. Really fascinating conversation. I hope we can have you back someday.
Likewise. Thank you again.
Yeah, thank you for joining us.
What Goes Up will be back next week. Until then, you can find us on the Bloomberg terminal, website, and app, or wherever you get your podcasts. We'd love it if you took the time to rate and review the show on Apple Podcasts so more listeners can find us. And you can find us on Twitter. Follow me at Regan Anonymous. Vildana Hajric is at Vildana Hajric. You can also follow Bloomberg Podcasts at Podcasts. What Goes Up is produced by Stacey Wong. Thanks for listening. See you next time.